After sticking close to around the $70 level for quite some time, SCHD has now fallen off a cliff and now trading well below $70 per share. Now this is due to multiple factors, but for the most part, several of SCHD's top 10 holdings, including names like Pepsi, Chevron, Cisco, Amgen, and others, have all recently seen massive declines in their share price. Now in this video, we are going to analyze the Schwab US Dividend Equity ETF and where it sits as of right now, and of course why, in my opinion, this is a multi-decade buying opportunity for one of the best dividend growth ETFs across the entire market, and I'm also going to explain on why I've been loading up like crazy. Before we get into today's video, make sure to please hit the first link in my description to support my brand new Patreon to access things like my 31-page A to Z dividend investing ebook, access to my brand new custom dividend tracker to track all of your ongoing progress, to view my 7-figure dividend portfolio, and so much more. I can't wait to see all of you guys inside. So first off, digging a little bit deeper into the culprit and why the SCHD ETF has been selling off like crazy. In the last few trading days, companies like Amgen, Cisco, AbbVie, Broadcom, Home Depot, and Chevron, all super high quality names in my opinion, and all dividend growth kings, have all seen a minus 5-day return from anywhere from around 2% all the way down to around 13%. Now because of the recent sell-off of some of the top names in the ETF, the ETF just recently dropped down to a brand new fresh 52-week low, which as of right now it's trading a little bit off it at around $66 per share. Now this is after, for the most part over the last few months, SCHD is pretty much traded in the low 70s, not really breaking too far below that. But with the ETFs holding breakdown, and of course the top 10 holdings, companies like these right here: Amgen, Verizon, Merck, Broadcom, AbbVie, Coca-Cola, Pepsi, Cisco, Pfizer, Chevron, and more. The ETF is definitely still experiencing some pain, but I think it's a massive buying opportunity. Now, one of the main reasons on why I think this could be a massive buying opportunity for investors with a long time horizon ahead of them is first off because SCHD does pay a dividend in about a month and a half from now, and at least historically speaking, the December dividend is always one of the biggest, if not the biggest, of the year. Now, one thing to pay close attention to, and one thing that's going to be on my radar for sure, is if or if not SCHD is going to raise their dividend in the up and coming December payouts. Now this next dividend payout for SCHD is going to be crucial in my opinion for multiple reasons. If the dividend is increased and if the dividend growth rate continues to move up, like we've seen in the past, this is sort of going to solidify, at least in the short term, the thesis for SCHD as an investment for long-term holders like myself that want to buy into this ETF to hold on to a high-quality basket of holdings, but also be able to benefit off that healthy long-term dividend growth. Now, if the up-and-coming December dividend payout is, let's say, flat or even lower than the previous dividend payouts that we saw last December in 2022 of 70 cents per share. Now that definitely could put some more stress on the ETF, and I do think we could see a little bit of an outflow if that sort of thing does happen. But with a lot of the top 10 holdings increasing their dividends over the last few months even, I'm pretty optimistic to think that the future dividend payout should be nice and healthy. Now another thing that I'm personally very particularly optimistic about when it comes to SCHD as far as a long-term holding, and why I personally have been buying say 2, 3, or 4 shares on a consistent daily basis over the last few weeks, especially when the ETF has been beat up in price, is the fact that the annual reconstitution is going to be coming up very soon, and we've went over what this is in the past in my previous video, so definitely take a look at that. But basically certain stocks within this ETF are going to be removed and certain stocks are going to be added. You see, one of the best things about the SCHD ETF is the fact that it does have such a rigorous, strict filtering process on whether or not stocks can be added or, of course, taken away from the ETF. And this is one of my favorite things about this ETF and lets me sleep good at night. Because in a second here, you are going to see exactly what this rigorous filtering system is and why I think it's one of the best systems for an ETF across the entire market. Now, because the SCHD ETF does track as closely as possible before fees and expenses the Dow Jones US Dividend 100 Index. And just to confirm, it does say that right here on the website, just so you know I'm not making that up. If you've never seen this before, this is very important and listening closely. This right here is the Dow Jones US Dividend 100 Index methodology. And this is exactly one of the reasons why I'm so bullish on this ETF long term, and why I think as of right now, where it's trading could be looked back on as a massive buying opportunity for investors in the future. Now the reasoning being is because stocks must pass the following screens, or what I was calling earlier filters, if you will. Now these screens or filters are things like a minimum of 10 consecutive years of dividend payments. So just right off the bat, if a stock doesn't have a minimum 10 years of consecutive dividend payments, it's not even going to make it to step 2, if you will. Now, there's a lot of stocks out there that don't necessarily have 10 years of consecutive dividend payments. That's sort of a lot to ask for a company. But of course, just to mention that if a stock does pay dividends for 10 years in a row, it doesn't necessarily mean that it's a super high quality stock just off the bat, so there's even more screens to go through. The next screening will be a minimum FMC of US 500 million and then a minimum 3-month ADVT of US 2 million. It then says index construction. Constituent selection is as follows. So this is how stocks are eligible or not to become a part of the ETF. The eligible securities that pass the following screenings are going to be ranked by each of the 4 fundamentals-based characteristics. Things like free cash flow to total debt, a very, very important metric when analyzing a stock. Annual net cash flow from operating activities divided by total debt. Companies with 0 total debt are ranked first. So once again, like I was saying earlier, the screenings, the filters that stocks have to go through during the reconstitution to be added into this index is, in my opinion, pretty rigorous, which is what allows me to sleep well at night. It then says return on equity, annual net income divided by total shareholder equity, IAD yield, and 5-year dividend growth rate defined as this formula right here. It then goes on to explain how they're ranked from there, and that constituents that are already in the index are going to be higher ranked. Now, I know what you might be saying. Well, if you're so bullish and so sure that this index filters and screening are sort of a perfect construction for this ETF, then why is the ETF performing so bad this year? And what about some of the names in the ETF that aren't necessarily all that favorable? Now, honestly, that's a good point, and I will say even with the strict screenings, some bad eggs are still going to make it through, and that's just sort of something that you're going to have to deal with pretty much any ETF. But the cool thing about ETFs is, of course, there's multiple different stocks within the basket of holdings, so even if there are a few bad apples, normally, hopefully, the good outweighs the bad. But I think it's important to mention that some of these names, especially the top 10 names, are most likely going to be shifted around quite a bit during the next reconstitution, and I'm very, very bullish of what that future outcome is going to look like. So for investors like myself that do have a long-term time horizon ahead and that are willing to weather the storm, whatever that means, whatever stocks make it through the screenings in the meantime, I do think that the overall index construction for the underlying index that SCHD tracks is a very high quality way to pick stocks. And obviously it has been historically because SCHD has outperformed many other ETFs across the board and is up over 160%, not even including dividends. So for investors that think that the future holdings are going to only become better and better because of the screening process, and for the investors that are willing to lock in almost a 4% starting dividend yield with major dividend growth historically, the SCHD ETF at these levels could be a major compounder in the years ahead. But now I want to hear what you guys think down below when it comes to the Schwab US Dividend Equity ETF SCHD. Are you currently buying at these levels under $70 per share? Let us know in the comments why or why not. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.